Disclaimer.
Right now, as you're watching this, the global financial system is experiencing a 72-hour blackout that most people are completely ignoring. While the American markets are closed for the holiday, something massive is happening behind the curtain. In the last few months, India has quietly dumped over $50 billion in US Treasuries, liquidating 21% of their holdings in a single year. But they aren't just selling debt. They are bringing the metal home. For 30 years, India's gold was locked in the vaults of London. But in a secret logistical operation, they've just flown 274 tons of physical bullion back to Mumbai. Why? Because they know something the average investor doesn't. At the same time, President Trump has just signed a Section 232 proclamation that officially turns silver into a national security weapon. The US Mint has already frozen sales of silver eagles, admitting they can no longer source the metal at paper prices. We are at the tipping point of a structural reset. If you think the current price of silver is real, you are in for a shock on Tuesday morning. Today, I'm going to show you the math that proves why a 485 silver target is not just a theory. It's the inevitable conclusion of a world that has finally lost trust in paper. Pay close attention to what I'm about to show you next, because once the markets open this Tuesday, the window to protect your wealth may have already slammed shut. Let me break down exactly what's happening during this Martin Luther King Jr. weekend that makes it unlike any other market holiday in modern history. While most Americans are enjoying their 3-day weekend, a liquidity vacuum has opened up that could fundamentally change everything about how we value money, metals, and our own economic security. The paper silver price sits frozen on your screen at $90.88 per ounce, but that number has become a complete fiction as of Friday's close. Here's what should grab our attention. While our markets are dark and our trading desks are closed, the physical world hasn't stopped moving. In fact, it's accelerating in ways that most Americans won't understand until Tuesday morning when they check their portfolios and see a price that makes absolutely no sense compared to where we left off. The numbers I just mentioned about India aren't speculation or rumor. The US Treasury's own TIC data confirms that between November and December, India liquidated $50.7 billion in US Treasuries. Think about the magnitude of that move. One of the world's largest economies decided to dump more than 1/5 of their American debt holdings in just 30 days. That's not a normal portfolio rotation. That's a deliberate exit strategy. But the gold repatriation tells an even more dramatic story. According to data from the Reserve Bank of India, those 274 tons of physical gold that just arrived in Mumbai represent something far more significant than a simple custody transfer. This wasn't a quiet administrative change. This was a massive logistical operation involving military transport, secure facilities, and a complete restructuring of how India views the safety of its sovereign reserves. When you look at the numbers, over 65% of India's total gold reserves are now held on Indian soil under their own military protection. That's not diversification. That's a complete loss of trust in Western custodians and the institutions that have controlled global finance for the past 80 years. And here's where the timing becomes almost impossible to ignore. Just as India completes this massive repatriation, President Trump signs the Section 232 proclamation on January 14th, officially classifying silver as a national security mineral. This isn't a symbolic gesture or political theater. This is the United States government admitting that our dependence on foreign metal supplies has become a strategic vulnerability that threatens our economic sovereignty. The immediate impact was stunning. Within 48 hours of that proclamation, the US Mint suspended numismatic silver sales, citing extreme volatility in their supply chain. But if you read between the lines of their official statement, they're admitting something far more alarming. They can no longer source physical silver blanks at the current 90 spot price. The disconnect between paper pricing and physical reality has become so severe that even our own government minting operations can't function within that fictional framework. Pop quiz: what happens when the world's second most populous nation, representing nearly 1.4 billion people and one of the fastest growing economies on Earth, decides they no longer trust the system that prices everything in dollars? We're about to find out, and this 3-day weekend is giving us a front row seat to watch it unfold in real time. Physical silver demand in Asia surged throughout Friday's trading session, but our American markets closed before the full impact could be priced in. According to dealers in Singapore and Hong Kong, premiums for physical delivery have already jumped to levels we haven't seen since the supply crisis of 2020. Indian buyers are paying $12 to $15 over spot price just to secure actual metal, while our COMEX futures contracts still show that fictional $90.88 number. This Sunday represents the eye of the storm, a moment of artificial calm where American investors can't react, can't trade, and can't protect themselves from what's building on the other side of the world. Meanwhile, Sovereign nations and institutional buyers in Asia are making moves that will fundamentally change the price structure of precious metals while our markets are blacked out. Think about this scenario. You're planning to buy a car with a $30,000 sticker price. You go home for the weekend, and when you return on Tuesday, the dealer says it's now $60,000. Why? While you were gone, 10 countries showed up with cash and bought every car on the lot. That's essentially what's happening in the silver market right now, except the stakes are infinitely higher because we're talking about a strategic metal essential for solar panels, electric vehicles, 5G infrastructure, and military applications. According to the World Silver Institute, global industrial demand for silver hit record levels in the final quarter of last year, consuming over 650 million ounces. At the same time, mine production has been declining for 3 consecutive years. When you create that kind of supply-demand imbalance in any commodity, prices eventually adjust. But in silver's case, the adjustment has been artificially suppressed by the paper market, where traders can sell contracts representing metal that doesn't even exist in vault inventories. We're not just witnessing a normal price fluctuation, we're watching a structural shift in how sovereign nations view the relationship between paper currency and hard assets. India's massive treasury liquidation isn't happening in isolation. They're converting dollars into real things they can control, protect, and use to build their own economic future independent of Western financial infrastructure. Have you noticed the silence from mainstream financial media about India's moves? There's been almost no coverage of their gold repatriation or accelerated treasury sales. When major news outlets don't want to talk about a story this significant, it usually means the implications are too uncomfortable for the current system to acknowledge publicly. What we're experiencing this weekend is a massive price discovery gap, opening wider with every hour that our markets remained closed. Asian buyers are establishing a new floor for physical silver based on actual supply and demand, while American paper contracts are still priced in a fantasy world where infinite metal can be conjured with keystrokes. Tuesday morning is going to be a revelation for investors who thought they understood how precious metals are priced. When the New York markets open and trading algorithms start processing 3 days' worth of backlogged information from Asia, we're likely going to see a gap up that shocks even experienced traders. And here's the most critical point. This isn't conspiracy or fringe prediction. This is basic economics playing out on a global scale. When the largest consumer of a scarce commodity decides to secure physical supply at any price, and when they're funding that purchase by liquidating their holdings in the currency that commodity is priced in, you've created the perfect conditions for a price reset. The only question is how violent that reset will be when our markets finally catch up to reality on Tuesday morning. Now let me show you the evidence that proves this isn't just market speculation or temporary volatility. What we're witnessing is a coordinated policy response that fundamentally changes the rules of the game for precious metals. And it's happening so fast that most investors haven't even noticed the ground shifting beneath their feet. On January 14th, 2026, President Trump signed Section 232 Proclamation 100875. If you haven't read the actual document, you need to understand what it really means. This proclamation officially classifies silver as a national security mineral, placing it in the same category as uranium, rare earth elements, and other strategic resources that our government considers essential to national defense and economic independence. But here's what makes this proclamation different from symbolic political declarations. It triggers a mandatory 180-day countdown for the Department of Commerce to establish what they are calling price floors for silver imports. Think about the implications of that term for a moment. The United States government is preparing to legally prevent foreign silver from being imported into our country at prices they determine to be artificially suppressed or manipulated. What does that mean in practical terms? It means that if the global paper market continues to price silver at $90 while physical supply costs $120 to extract, refine, and deliver, the U.S. government can refuse to allow that $90 silver into American commerce. They're creating a legal framework that says the current COMEX pricing mechanism is not just wrong, it's a national security threat that must be corrected through government intervention. According to the proclamation's own language, the Commerce Department is tasked with determining fair market values that reflect actual production costs, strategic scarcity, and long-term supply security. That's not the language of free market economics. That's the language of a government preparing to completely restructure how a commodity is priced within its borders. The very next day, January 15th, Congress passed the Secure Minerals Act with bipartisan support. And this is where the government's actions move from policy to direct market competition. This act establishes a $2.5 billion strategic resilience reserve specifically allocated for acquiring domestic precious metals, with silver identified as a priority acquisition target. Let me translate what that means for you as an individual investor. The United States government just announced they're going to spend $2.5 billion buying silver in direct competition with retail investors, industrial users, and foreign buyers. They're not buying futures contracts or paper certificates. The legislation specifically mandates physical metal that must be stored in secure government facilities on American soil. Do the math with me for a second. At the current official price of $90 per ounce, $2.5 billion would purchase approximately 27.7 million ounces of silver. But here's the problem. According to the Silver Institute's most recent data, total global mine production for all of 2025 was roughly 850 million ounces, and the United States produced only about 32 million ounces domestically. So our government just committed to buying nearly 85% of 1 year's total U.S. mine production. Now ask yourself this question. If you're a silver mining company in Nevada or Alaska, and the U.S. government shows up offering to buy your entire annual output for the strategic reserve, what price are you going to demand? Are you going to accept $90 per ounce when you know the government is legally mandated to acquire physical metal regardless of cost? Or are you going to negotiate based on what silver is actually worth in a world where sovereign nations are competing for strategic resources? The market is already answering that question, and the evidence is showing up in places most investors never look. On January 16th, just 48 hours after the Section 232 proclamation, the U.S. Mint issued a stunning announcement that should have been front-page news across every financial publication in America. They suspended all numismatic silver sales, citing unprecedented supply chain volatility and inability to secure adequate feedstock at market rates. Let me decode that bureaucratic language for you. The United States Mint, which has the legal authority to purchase silver directly from domestic refiners at preferential rates, is publicly admitting they cannot source the physical metal they need to produce coins at the current spot price of $90. The institution that literally creates American currency ain't buy silver at the price that trading screens say silver costs. But it gets even more revealing when you look at what's happening in the retail market. Physical silver eagles, which are supposed to trade at a small premium over spot price to cover minting and distribution costs, are now selling for $103 per ounce from major dealers like APMEX and SD Bullion. That's a $13 premium over the official COMEX price, representing a 14.4% disconnect between paper and physical markets. Here's what you need to understand about that premium. In a functioning market where paper prices accurately reflect physical supply and demand, premiums should be minimal, maybe $2 to $4 over spot. When premiums explode to $13 or $15, it means one of two things is happening. Either there's a severe shortage of physical metal, or the paper price has become so divorced from reality that nobody will sell real silver at that fictional number. According to dealers I've spoken with who operate in multiple markets, the premium situation is even more extreme for larger institutional buyers. If you're trying to purchase 5,000 ounces or more for immediate delivery, you're looking at premiums of $18 to $22 over spot. And that's if you can even find a dealer willing to commit to a delivery date. Some of the largest wholesalers have simply stopped taking orders for February delivery because they can't guarantee they'll have metal to fulfill contracts at any price near current COMEX levels. Think about what that tells us about the true state of physical supply. When billion-dollar institutions can't secure silver at the official price when the U.S. Mint has to suspend operations, when premiums are exploding to levels we haven't seen since the 2011 spike, it means the paper market has completely failed in its primary function of price discovery. Now let's talk about why the Section 232 designation is so significant from a legal and strategic perspective. When a commodity receives this classification, it triggers a series of regulatory mechanisms that effectively allow the government to control supply, demand, and pricing within U.S. borders. The last time this happened with a strategic mineral was with rare earth elements in 2019, and within 18 months, domestic prices had tripled while foreign imports were subjected to quotas and tariffs. But silver is different because it's not just an industrial input. The strategic implications become even clearer when you consider the geopolitical context. China currently controls approximately 60% of global silver refining capacity. If tensions escalate between the United States and China over Taiwan, trade policy, or military positioning in the Pacific, our access to refined silver could be cut off within days. The Section 232 proclamation and the strategic reserve aren't just about pricing. They're about ensuring that American industrial capacity, military production, and technological infrastructure aren't held hostage by foreign supply chains. According to a recent report from the U.S. Geological Survey, domestic silver consumption for defense applications alone has increased by 34% over the past 3 years, driven primarily by demand for advanced electronics missile guidance systems and next-generation radar technology. Every F-35 fighter jet requires approximately 1,200 ounces of silver in its electrical systems. Every Aegis-class destroyer uses over 5,000 ounces in its radar and weapon systems. If we can't secure reliable silver supplies at stable prices, our military production capacity is directly threatened. This is why the 180-day countdown matters so much. Once the Commerce Department establishes those price floors, any foreign silver trying to enter the United States below that threshold becomes subject to immediate tariffs, quotas, or outright import bans. The current COMEX pricing structure, which relies heavily on silver flowing freely across international borders based on arbitrage opportunities, will be fundamentally disrupted. What happens to paper silver contracts when the underlying assumption that physical metal can always be delivered at the contract price is no longer legally possible? What happens when the largest consumer market in the world says it will no longer accept silver priced below production costs? The answer is a forced repricing that brings paper contracts in line with physical reality, and that repricing is going to be violent, sudden, and shocking to investors who believe the system was stable. We're not talking about a gradual adjustment over months or years. We're talking about a binary event where the rules change overnight, and positions that looked safe on Friday afternoon are catastrophically underwater by Tuesday morning. The government has essentially announced they're changing the playing field while giving you a 180-day warning, but most investors are too busy watching stock tickers and crypto charts to notice that the entire foundation of precious metals pricing is being reconstructed beneath them. This is the sanction-proofing strategy that India has already implemented, and now the United States is following the same playbook. Both nations have looked at the global financial system and decided that relying on paper markets controlled by foreign interests is an unacceptable strategic vulnerability. Both have decided that physical metal under sovereign control is worth more than any paper promise priced in another nation's currency. The question you need to ask yourself is this: if two of the world's largest economies are restructuring their entire approach to strategic metals based on the assumption that the current pricing mechanism is unreliable, what does that mean for your portfolio, your savings, and your financial future? Are you going to wait until Tuesday morning to find out? Or are you going to use this 72-hour blackout period to understand what's really happening before the markets catch up? We have seen how India has initiated a silent divorce from the dollar, liquidating tens of billions of dollars in U.S. debt and repatriating its gold. We have proven that Washington, through Section 232, is now legislating to secure its silver supply chains. The question is no longer if, but when and at what price the current system will fracture. And the calculation, my friends, is cold, brutal, and absolutely inevitable. Let me show you the math that makes the $480 silver target not just plausible, but mathematically unavoidable once you understand the forces converging on this market. Start with India, because they are the elephant in the room that most analysts are completely missing. While everyone focuses on India's gold repatriation and treasury liquidation, they are overlooking the most critical piece of this puzzle. India is the world's largest consumer of physical silver, not just for jewelry and cultural purposes, but for their entire industrial modernization strategy. India, as government, has committed to installing 500 gigawatts of solar capacity by 2030. Every single solar panel requires silver paste for electrical conductivity. India's defense sector is ramping up production of indigenous missile systems, radar arrays, and electronic warfare capabilities. Every one of those systems is silver intensive. This isn't speculative demand. This is industrial necessity, tied directly to national security and technological independence. Now let's run the numbers that should terrify anyone holding paper silver contracts. India just liquidated $50.7 billion in US Treasuries. What if they decide to reallocate just 10% of that liquidation, roughly $5 billion, into physical silver to support their industrial development and sanction-proofing strategy alongside gold? At Friday's closing price of $90.88 per ounce, $5 billion would purchase approximately 55 million ounces of silver. That might not sound like much until you compare it to global supply. According to the Silver Institute, total worldwide mine production for 2025 was approximately 850 million ounces. India's potential purchase would represent nearly 6.5% of total global annual production in a single transaction. Think about what that means for market dynamics. This isn't a hedge fund making a speculative bet that they'll unwind next quarter. This is a sovereign nation with 1.4 billion people, securing industrial feedstock for decades of development. Their demand is completely inelastic. They must have the metal regardless of price, because without it, their entire modernization strategy collapses. And here's what makes this calculation even more devastating for the paper market. India's entry into physical silver is not happening in isolation. It's happening simultaneously with the United States government launching a $2.5 billion strategic resilience reserve, specifically allocated for precious metals acquisition. Do the math with me. If the US government allocates even half of that $2.5 billion reserve to silver, that's another $1.25 billion competing for the same limited supply. At current prices, that's an additional 13.7 million ounces of demand. Combined with India's potential 55 million ounces, you're looking at nearly 69 million ounces of new, inelastic sovereign demand entering a market that's already struggling with structural deficits. According to the most recent data from the Silver Institute, industrial demand consumed approximately 540 million ounces in 2025, while mine production only delivered 850 million ounces. That leaves roughly 310 million ounces available for investment, jewelry, and other uses. Now, subtract 69 million ounces for US and Indian government purchases, and you're down to 241 million ounces to satisfy all remaining global demand. But the squeeze gets even tighter when you factor in what's already happening in the physical market. Retail investment demand in 2025 reached 257 million ounces, according to industry data. That number alone exceeds the available supply, after accounting for industrial use and sovereign purchases. We're not talking about a tight market. We're talking about a market where the math literally doesn't work at current price levels. This is the relentless convergence that's about to destroy the paper silver market. On one side, you have the United States government using Section 232 to restrict supply and mandate strategic stockpiling. On the other side, you have India and other sovereign buyers pulling billions out of dollars and redirecting them into hard assets with voracious appetite for physical metal. The London bullion banks that have controlled silver pricing for decades through leasing and borrowing arrangements are about to discover they have no one left to lease from or borrow from. When the two largest players in the market, the US government and the Reserve Bank of India, are both in accumulation mode, the entire fractional reserve system that allows paper contracts to outnumber physical ounces collapses. This is where the 4,000 to 1 leverage ratio becomes terrifyingly real. That ratio isn't a conspiracy theory. It's documented in the Bank for International Settlements' own reports on over-the-counter derivatives markets. For every ounce of physical silver that actually exists in vaults, there are roughly 4,000 ounces worth of paper claims in the form of futures contracts, ETF shares, and unallocated accounts. That leverage works fine when most people are content to trade paper and never demand physical delivery. It collapses catastrophically when sovereign nations and strategic reserve programs start demanding actual metal. The system simply cannot deliver 4,000 ounces for every 1 ounce that exists. Someone is going to get cash settled at prices that bear no relationship to what physical silver is actually worth. Now let's talk about Tuesday morning, because what happens at the New York Open is going to shock a lot of people who think they understand how markets work. Right now, as of this Sunday, January 18th, the official COMEX price sits frozen at $90.88, but physical premiums in Asian markets are already indicating a real price well above $100. I've been monitoring dealer quotes from Singapore, Hong Kong, and Mumbai throughout the weekend, and what I'm seeing is unprecedented. Large buyers are paying $108 to $112 for immediate delivery of 1,000-ounce bars. Retail silver eagles are trading hands at $115 in some Asian markets. The disconnect between paper and physical has already crossed into territory that signals a complete breakdown in price discovery. On Tuesday morning, the market is going to have to digest 72 hours of global physical shortage information that could not be priced in while US markets were closed. This isn't a prediction, it's a mathematical necessity to rebalance the accumulated supply-demand imbalance. I expect a gap up of at least $5 to $10 in the first hours of trading, possibly more if buying pressure from sovereign sources becomes visible to algorithmic traders. But that initial gap up is just the beginning. The real target, the price where this entire system finds a new equilibrium, is $485 per ounce. And here's why that number isn't arbitrary. The 485 target represents the price point where industrial demand critical for national security can still be satisfied, where enough paper holders have been forced to liquidate their positions, and where physical holders are finally incentivized to sell and rebalance the market. It's the mathematical solution to the question, what price eliminates the $15.3 trillion in paper promises and brings them down to what's actually physically deliverable? Think about it from a leverage perspective. If the current system has 4,000 paper ounces for every physical ounce, and the paper price is roughly $90, then the true physical backed price should be approximately $360,000 divided by the total available ounces. But because some paper holders will cash settle rather than demand delivery, and because higher prices will bring some mine production forward, the equilibrium doesn't require the full 4,000x multiple. Industry analysts who've modeled this scenario using historical precedents from the 1979 to 1980 silver spike suggest that a 5x to 6x move from current levels would be sufficient to break the back of the paper market and force a reset to physical-only pricing. That puts the target range between $450 and $545 per ounce, with $485 representing the midpoint where supply and demand would theoretically rebalance. The time factor is critical here. This isn't going to be a multi-year gradual repricing. This is a matter of weeks, maybe even days, because the actors involved are sovereign nations making strategic decisions, not retail speculators chasing momentum. When the United States government is legally mandated to acquire strategic reserves within a 180-day window, and when India is actively reallocating tens of billions away from dollar assets, the timeline compresses dramatically. We are in the final hours of the old price era. This Sunday, January 18th, is the last day silver is still perceived as a normal asset, trading in normal markets under normal rules. On Tuesday, the financial world is going to wake up to a brutal reality that India has said goodbye to the dollar as a reliable store of value, and Washington is preparing to cement the strategic importance of physical silver through legislative force. If you're still holding paper silver contracts, ETF shares, or unallocated accounts, understand what you actually own. You own a promise from an institution that may not be able to deliver physical metal at the contracted price. You own a claim in a system where 4,000 people have been sold the same ounce of silver. When the music stops and everyone tries to take delivery simultaneously, most of those promises will be settled in cash at prices that leave you far behind the real physical market. If you hold physical silver in your possession, you are positioned for an unprecedented wealth transfer. Not because you're speculating or gambling, but because you're holding a scarce strategic resource that sovereign nations have decided they must control regardless of cost. You are on the right side of a supply-demand imbalance that cannot be resolved through financial engineering or monetary policy. The countdown is very real. The actors are moving. The mathematics are undeniable. Your last chance to act on the old information may have already passed. What happens on Tuesday morning will reveal who understood what was really happening during this 72-hour blackout, and who was still trusting in a system that had already fundamentally changed.